Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going through the comment section, going to answer some of your guys' comments or questions in the comment section and give you my financial opinion. Again, this is just my financial opinion. You don't have to use it as advice, just use it as another opinion. And my opinion may vary from another person, and your circumstance could be completely different than the circumstances that I'm experiencing in my life. So, I mean, some of this stuff, I have a little bit different outlook. I've got stable income. I've saved lots of money over my entire life. I am not living paycheck to paycheck. I am basically, I prioritize savings over everything else. So my viewpoint is from that perspective, from that paradigm. And I can generate a lot of money if I put my mind to it. So I have that option to always work and do things and generate cash. And some people don't have that ease of making money sometimes. So if I were to lose my job, I could probably find other jobs that pay pretty well in a wide variety of things. So here's a question. It says, Andy, would you choose to buy real estate by investing $60,000 in a down payment or $30,000 in uranium stocks and hope that uranium gains will outpace housing in the suburbs of major cities? So there's a huge difference between these two types of investments. Number one, I would suggest whatever you're basically an expert in. In my view, real estate is a steadier increaser. Like it's not as volatile. You also have more control over real estate than you would over uranium stocks. Uranium stocks, yes, we know they're cheap. You can kind of get in there, you invest, and then you're relying on the market to basically do the heavy lifting, to have it move up for you. And that it can work out, and sometimes it doesn't work out, and the timing could be off. In real estate, you can purposefully get a good deal. You can negotiate the deal. You have far more control over the outcome of that deal. You can also determine, what city, what portion of the city it's in. You can buy it. You can add equity or sweat equity to it. There's a whole bunch of things that you can do with real estate that you can't do with stocks. Stocks, and you'll find this out over a long period of time, is that you're much more, you're subject to whatever whims the market gives you in stocks. Real estate is more steady, and it usually goes up, and when it's in a bull market, it continues to go up until it doesn't. It's steady when it goes up. It's not one week it's this price, and then a month later it's 50% down. It doesn't. It's a much more steady game. And if you find a really good deal in real estate, you can use, obviously, borrowed money from a bank. And what you're doing is you're making a leveraged bet. A leverage is that you're taking on debt, and it's a bet that you can add value to the house, and you can either flip the home or you can get cash flow from the home. And you can do calculations to say, hey, look, this is what I'm going to put down. This is what I'm going to loan. This is my interest rate. I can get a 30-year fixed rate interest rate. This is what my payments would be and my maintenance cost. You can kind of get a really good picture there. And then you could say, this is what the potential cash flows could be. In a uranium stock, you don't have any of that. I mean, you are going way out, in my opinion, on a lot more risk because most of them don't have cash flows. We are under the cost curves, et cetera, et cetera. But the returns in uranium could be quite substantial. The returns in real estate could be very substantial because you're taking a leveraged bet. So if you put a down payment on a house and the house goes up $100,000 and you put $100,000 down on the house, you doubled your money. You won't have that type of leverage in stocks because you're not loaning the money. But that leverage can also work against you if the housing market were to turn around and go against you. I don't think that's going to be the case. That's my opinion. I think housing is going to go up substantially over the next few years, and maybe even longer than a few years. It might be 5 to 10 years. That's kind of where I think how long this market's going to last. And again, guys, I'm not a real estate expert. What I do is I look at investing. I'm a macro guy. I look at all the value out there, and I look for the cheapest investments. I would say that real estate is one of the cheapest investments, and I know that sounds weird. It's cheap in relationship to stocks in history. It's never been this cheap. It's actually cheap against gold still. So it's cheap against gold. I can't really find too many metrics where it's not cheap. It's probably cheap against the money supply. I mean, any metric you use, it's cheap. And everyone thinks it's expensive because all they look at is price, but they know the value of nothing. Price is nothing. Price is just a measuring stick of what someone's willing to pay at a current moment. The value is when you start measuring against other items. And if it's cheaper than everything that you measure it against, then it's cheap. And real estate right now, I think, is cheap. If you were to look at the affordability of real estate, it is also incredibly affordable in relationship to history. It's not super, super expensive. It's not in the top 10% of the most expensive times in history. We're coming off what was the cheapest affordability, the best affordability in the late 2000s, early 2010s. That's the best affordability that anyone's ever seen with interest rates low and house prices that low. And everyone's comparing it to the cheapest time in history. So obviously, it's going to look expensive in comparison to the cheapest time in history. But look at it in the 90s. Look at it in the 70s. It's cheaper now than it is back in most periods. So yeah, I think I would probably choose a house over uranium stocks only because you have more control over it. And wherever you can have the most control, wherever you can have a risk-adjusted return, have super low risk with a good return, I think that's the spot that we should always hit. It's kind of like you're walking around, you're in a city, and you're finding deals, finding value, finding deals. Yeah, you're finding deals, and what you can do is you can just walk around and you can pick up stacks of $100 bills. Now, what you're asking or proposing in some of your guys' scenarios is, well, what if I could pick up $1 million in one shot? But the risk I have to take is immense. Or I could just walk around and grabbing stacks of, maybe it's like $1,000 at a time, 1,000 here, 1,000 here, 1,000 here. What you're going to find out is over time, it's more than likely best to skip out on the really low likelihood of winning big on some of this stuff and just start picking up $1,000 stacks everywhere. That's a really good strategy. Just go around, pick up $1,000 stacks throughout the city if that's available. And we are at incredibly low commodity prices. So uranium is an incredibly good deal, and I think that the returns could be incredible. Same with a lot of other commodities like oil, natural gas, all of them. They're all incredibly cheap, and they all have very good opportunity. So I'd like to choose the stuff that's lower risk, more control, wherever possible. Because if you know you can get a really good return there, I would hit that up first. But that's me. And some people they're gonna differ in their responses. Hi Andy, what would be the best buy 3 oil stocks at the moment? It highly depends on what your goals are and your risk tolerance. I think ones that I recently purchased, and again, guys, this isn't advice. I'm just telling you what I did. I bought Northern Oil and Gas, NOG. I bought Crescent Point Energy, CPG. I think TEL is pretty good still, TELL. I think RECAF is good, RECAF, and they're getting targeted by short sellers, and I think it's providing opportunity. I think that they're being honest, as far as I can tell from everything I can read. I think they have plans in place, and I don't know why they would have plans in place. They're too coordinated, and they have too many long-term plans, and the details worked out too well for them to be lying. So I don't think they're my take on it is that they're not lying and that we have a good entry point right now. But I'm not trying to sell this stock. It's a exploration high risk play. They're going after a lot of oil, and if it turns out well, then it's going to end well. If they are lying, I don't think they are, but you know, there's a lot of short sellers trying to jump on that stock. I don't know why, but I'm riding it up with the money I put in there. So those are the three that I think are good at this second. Why do I think they're good? Because we're breaking some. They're right at their resistance levels. We're still like in downtrends or accumulation phases, and they're just starting to break to the upside. And when they do that, that's where opportunities are. It's before they break. When they break, and we're seeing that we've got positive developments in natural gas and oil, when they break their trends, that's when you can really start to shoot higher. We've seen that shoot higher in all of our companies. Another group, CDEV, CPE, CDEV, CPE, and SM Energy are also creating patterns. And when they break these patterns and they move up, I mean, they're just going to continue going from pattern to pattern, using them as basing. So they base a little bit, they pull back a little bit, and people get scared. They want to sell out. I just hold on because the ratios are so cheap, and then they jump higher. It's almost like they're leveling up every single time off of cup and handle patterns or reverse head and shoulders or patterns that are similar to those. So it says crude oil skyrocketing. Yeah, you got that right. I'm going to open up a thing here. I was going through. Let me see where it is here. So I've got this, and it's right here. I'm just going to zoom in and give you guys a quick update as well. I was kind of looking at some of the charts here. This is the gold to oil chart, a ratio, gold to oil ratio. And we've been moving on up here, and we're playing with this bottom rail here. And I think we're going to break out today and head lower. What this means is that we've broken out of the channel and that we could potentially compress oil quite dramatically against gold. I'd like to see gold firm up and start going higher. It hasn't been, but the conditions are there. And we're at the beginning of this expansion phase of real estate, which is inflationary in my opinion. And it's going to take some time for this inflation to work its way through. You've heard me say that before. And we've got that synthetic inflation, that stimulus and all this other stuff that's been created. And I think that will carry us to more inflation down the road. So I'm watching this ratio. It's starting to break to the downside here. And what that's telling us is that oil's outperforming gold and that we could go into a very big oil bull run. And we could be starting a commodity boom, which, I mean, that's exactly what we were expecting at the start of a commodity boom. The platinum to gold ratio also is broke to the upside, and we're back testing. This is a good spot to buy platinum, in my opinion, physical platinum. I know you guys always want to play leverage on it. If you do, be careful, because I don't have as much trust in the mining companies. I really like physical. But if I had to play it, I would play it with like an IMPUY, it's Impala Platinum, or a PLG. That's more of a developer, higher risk play. And I do own a little bit in those, not very much. Now, this is coming back. When this goes and breaks to the upside, platinum to gold ratio, what that signals, and when that outperforms, it's telling us the market conditions. The conditions are ripe for commodities and not ripe for stocks. This ratio is telling us that. So when platinum outperforms gold, it's saying that a commodity bull market is game on. And that's usually what happens at the beginning and middle stages of a commodity bull market, is you start to see this break the downtrend line, and then you start to see it come back up. And that's good for the ratio as well, because now if you're a platinum owner, you could buy more gold, silver, or whatever else in the future when that ratio changes. Now, looking at some of these other ones, I've got the XAU to gold ratio, and this thing is still, I mean, it's knocking out a pattern. We have not broken that pattern yet, but it's still putting in the bottoming process. We could come down a little bit more. It is of incredible value, which means that the gold and silver index in relationship to gold is still an incredible value here. And I think it's just a matter of time before this ratio reverses to the upside, which means that gold and silver miners will outperform gold at some point when it breaks this pattern. We're still in this pattern, and you notice that the pattern is 4 years, 5 years in the making from its bottom in 2016. So we do have higher lows. It is coming on up. We're compressing against this line here at some point. It's just not ready yet. It's still tracing out the pattern. And I'm just as bullish. I'm just as impatient as some people. We want it to break, but it's going to need more time. Now here's the CRB to S&P 500 ratio. This is basically commodity to stock ratio. We are breaking to the upside of this ratio. A commodity bull market is coming. It is verified through this ratio. And funds are seeking the CRB index more so than it is the stock index. It is outperforming. And I think we're going to see a continued outperformance of the CRB. And I think money is going to flow into the CRB over stocks with time, so long that interest rates go up. And it's going to take time. This isn't fast. You got to get your time frames right. Your time frame should be measured in 5 to 10 year increments, not months or weeks. But this is looking good. It's moving on up. It looks great. Copper is another important one to measure. We're in this pattern going sideways right now. We have not broken out of it. So we're kind of in this consolidation pattern still. Still waiting for it to decide what it wants to do, and I think we're going to break to the upside. Oil is already breaking to the upside of its pattern. We had a false little breakout, and then it came right back up. Now we're moving higher. Oil and energy costs, if you look at energy just in general, we also have Hurricane Ida. Hurricane Ida messed up oil production in the U.S. Demand's been going up. Production down worldwide. And investment's also been going down. So if you look at just the entire energy spectrum, the energy spectrum has been going up immensely. I mean, energy has been rocketing higher in anything you want to measure. Coal, natural gas, uranium is going to be going higher. That's always seems to be lagged. And just be patient in this stuff. It's not about when I see a lot of people, they're asking questions, should I sell X and buy Y? And it could be, should I sell my silver mining companies and buy oil? Should I sell this and buy uranium? My strategy hasn't really changed from the beginning of this. My strategy is allocate a certain portion to the sectors that you want, come up with the strategy, and stick to the strategy. Just because another sector goes up in price doesn't mean that you should go chase price. What is the value of the sectors? Gold and silver are probably some of the best valued sectors at the moment. And in all reality, you'd almost want to do the opposite of what you guys are probably wanting to do. And I'm not saying to go out there and buy a bunch of gold and silver at the moment, but I mean, platinum is incredibly cheap. We're at anomaly. It's an anomaly in history, some of these ratios. Never been this cheap in relationship to some of the metals. Oil is realizing its value. And yes, it is exciting to see your account go up. But what I am actually starting to look at now is I'm looking at gold and silver mining companies, not really mining, I should say royalty companies and in physical metals right now for myself to purchase. And I'm doing my last purchases, I would say, in some of the energy companies. And uranium, I think, uranium might have some, I don't know what uranium's going to do in the short term. The charts have me kind of mixed. And it doesn't mean that I'm selling anything. Don't ever think that. What I'm doing is I don't know where to put money at the current moment in uranium because I don't know if it's going to go up or down. The short term, it could go higher. I mean, overall, the energy sectors are going higher, could go up. But the thing that gets me kind of, I'm not a huge synthetic. Some financial players are coming in and buying things. Are they going to be buying this indefinitely? The Sprott fund. So I know people look at it positively. I look at it as I'm completely indifferent. The Sprott fund is pushing it higher. Is it going to do that forever? I don't know. Are funds going to slow down? Probably. People get excited. And when people get excited, they throw money at it. And now people aren't as excited. So the rate's going to slow way down. What I'm looking for is the supply-demand imbalance and the demand to come with large buying pressure that is continued for many, many years is going to push this thing higher and basically sustain higher prices. That's why I invested in the sector. I didn't invest in the sector for a financial player to push it higher. Will it be sustaining? I don't know. But I'm here for the long run. And in the short term, I can't tell you where it's going to go. I'm indifferent on where it's going to go. And honestly, I'm not going to sell anything. I'm just going to hold on. Would I buy a little bit more? Yeah. In my favorite ones, I'll add a little bit where I think I'm a little bit lean. And that's all I'm doing is I'm continuing to add where I think I'm leaning. And whenever things come way down, that's where you have to buy. You have to buy on the stuff that makes you feel like you shouldn't be buying it almost if you're new. If you're seasoned, you know what you're doing. And that's why I'm kind of looking at these silver stocks that are way down there. And I'm going, well, maybe I should buy some here. I don't chase price, guys. And if we get more sell-off, if we get a greater sell-off in silver or gold and the equities go with it, I might start buying a couple of these mining companies again because they're getting cheap. They're getting very, very cheap, and I'm getting pretty interested in the sector again because it's getting this cheap. And everyone else is not. I mean, they are turned off by gold and silver. They want to sell their stuff, and you know what? That's when you want to buy because we're basically hitting a point where sentiment's falling to a super low, and if there's no more buyer or if there's no more sellers, then there's no more sellers. It can't go down anymore, or it can't go down as much. So your risk reward is very good at these points, I think, coming up. So I'm looking at it. It hasn't bottomed yet. I'm waiting for the bottom. I'm waiting for the turn, and then I'll add a little bit in. And I'm running out of money, but I'll keep adding whatever I can when opportunities present themselves. If you guys like this content, subscribe to the channel, give me a thumbs up, and thank you for listening. This is Finding Value.